Hello everybody, welcome to the February, Thursday, and Friday, 27th through 28th price review. So getting started, we are looking at the NASDAQ and the S&P. And as you guys know, since Monday, we wanted to see these lows on the NASDAQ get hit, and that is exactly what we got Thursday. And on the S&P, we saw this low get hit a little bit earlier on in the week. But whenever you have that happen, whenever one asset takes out a target, and the other asset is kind of lagging behind, you can still expect price to trade in that direction until both targets are met on both assets, unless it is sequential SMT that causes price to reverse. So looking at Thursday's price action, as you guys can see, we have the true day open marked out for the S&P and the NASDAQ, looking at it through the lens of the 1 hour time frame. And we also have that 6 o'clock opening price as well. So coming into the trading day, since the narrative was still bearish and we were trading above 6 o'clock as well as the true day open, this was a high probability scenario to look for short continuations, which is what we got. And whenever you see this, whenever you see price trading above the 6 a.m. open and the true day open, whenever you're bearish, things that form above these two price points tend to be a bit higher probability. And that is exactly what we saw with this hourly TPDR here. So this was the 7 a.m. candle, and as you can see, we have this opening price right here, which is lower than this closing price on the S&P, but on the NASDAQ we have this open, which is higher than this close, creating that cracking correlation. Now looking at that portion of price action through the lens of the 15-minute chart, as you can see, this would be that hourly candle range, viewing it through the lens of a 15-minute time frame. And then we have our reversion level right here. 8 a.m. opens up, tags into that reversion level, hits only the wick, and then runs off. While the NASDAQ, on the other hand, creates that reversion level, but whenever price trades into it, it trades into the actual body, and as well as the 9 a.m. candle trades into it as well. So how to predict when things like this will happen, or quote unquote, the best case entry? It comes down to, number one, knowing the narrative, as well as picking the asset that creates the cracking correlation stronger to the direction of that narrative. So the S&P, since it created that lower open, it was more exposed to running off quicker and then continuing down, while the NASDAQ, it made that higher open, which is why it hung around that reversion level for a little bit and then ran down. So that was the A+ entry model, or entry setup, for Thursday, which we anticipated Thursday to be one of the better trading days of the week. And as you guys saw on Thursday, we had that really nice drop. And something that I see a lot of you guys say is where to actually take profits at. So whenever you do get into a trade and you've secured your either 1 to 2 or 1 to 3 risk to reward, and you've taken off about 80% of the position, there's different things you can do whenever it comes to actually holding on to the trade. So number one, you can look for short-term highs and lows. For example, this would be a short-term high and low that has been created the same day that your setup forms. So for example, this was an Asia session low right here, and then that reversal got created in New York session. So that could have been an area to fully take out after securing your risk to reward within here. You can also look at previous days highs and lows. As you can see right here, this would be a previous day low, and this would also be a previous day low. Or you could hold the trade until it hits the weekly objective, because if you guys have been paying attention, that's pretty much what I've been teaching you guys how to do, is look for something in the morning to where you can put on a trade that allows for you to encapsulate the entire weekly expansion or majority of the weekly range. So once you get your 1 to 2 or 1 to 3R, that day trade can sometimes turn into a swing trade. And now we're going to focus on the price action of Friday. So generally, whenever the entire week expands, like it did this week, you can expect Friday to return into the weekly range, which is what we got. So the same principles that apply to non-farm payroll weeks, you can also apply that to regular trading weeks if there is a red folder news event on that Friday. Now, since we had this extremely large range right here that presented itself on Thursday, it's typically a little bit more difficult to navigate days that follow large range days. So if you found today pretty challenging or just tough to gauge a direction, then that's something to write down for your notes. because you experienced it firsthand on what it's like to trade after an extremely large range day. But now looking at the price action that actually happened on Friday. So as we can see, there was no inherent sequential SMT with these lows right here. There was with the Dow, but it was, in my opinion, low probability. But the main factor that tipped its hand, and another way to confirm the Dow and things of that nature, whenever things like that take place, is hidden SMT. So as you can see, this right here is the lowest close of London session, while this is the lowest close of the morning session. So this is higher than this on the S&P, while on the NASDAQ, we can see that this close is lower than this candle's close right here, creating that Kraken correlation. So even though it didn't make sequential SMT with the wicks, the body still tipped its hand, as well as the quote-unquote low probability Dow tipping its hand. So whenever you do have a Kraken correlation with the Dow, you always want to look for a reason for it to hold substance between the S&P and the NASDAQ. And if we look a little bit closer, after that hidden SMT formed, we can see there was a TPD right here. And if we look within that TPD a little bit further, we can see that there was a reversion level right here on the S&P. This was that 10 o'clock opening price, and this is that reversion level. And we're looking at price through the lens of a 5-minute time frame, but this orange shaded area right here is a 15-minute candle. So as you can see, this could have been very difficult to navigate and low probability to navigate, because on the NASDAQ, we did not have a change in the state of delivery until that 10 o'clock 15-minute candle open, closing above this high, while on the S&P, it had already closed above this high. So whenever you see things like this, of one asset creating the change in the state of delivery while another doesn't, it's always best to trade the one that actually creates this change in the state of delivery, and then using that as the reversion level. As you can see, price wicks within there, and then trades higher, trading into the early morning session highs. And especially on days that you can anticipate to be low probability, you don't want to hold on to trades for too long, because it is likely to roll against you and pretty much do exactly what it did this afternoon of creating that large expansion